أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم الحمد لله رب العالمين والصلاة والسلام على رسول الله وعلى آله وصحبه ومن والاه أما بعد السلام عليكم ورحمة الله وبركاته. Welcome back to another episode of our regular Friday talk. The topic is Islamic finance, and we started last week. And as I said, I pitch it within the context of global Islamic economics. Islamic finance is one of the sectors. There are about 7 sectors that have been identified and they are developing. And the Islamic finance is one of them, and this is the largest one. And it encompasses other areas like Islamic banking, Islamic investment, Islamic insurance, and we're aiming to cover those topics, inshallah. So last time we started with Islamic finance, and so I will backtrack. We did 2 contracts, but I'll backtrack to make sure that we are all on the same page. So we said Islamic finance, the financial system in general, whether it is Islamic or it is conventional, it operates under the principle that you have 2 groups of, people, those who have financial resources and they want to earn income from those resources, meaning those who have access funds or excess resources, and they're ready to borrow others so that they can have income. And you have another group that needs funding, so they have less. Okay, they need funding or they need financing for various economic activities, whether personal or business related. So this is the basics. Now, in a conventional finance, the conventional finance is mediating between these 2 groups, and what they can offer is loans with interest. That's all. All kind of loans, but they are loans, with interest. So with the riba. But with Islamic finance, where we cannot, do this transaction through riba, we have to come up with some alternative method. And this is where we have all these Islamic contracts. So we group them into 2 groups or 2 modes of Sharia compliant financing. So last time I told you that there is an indirect mode of financing. Sometimes it is referred as debt-based financing. This is where you go to the bank and you want a loan, but the bank will not give you cash. Will ask you what is the purpose for this loan, and they will try to meet your needs by buying asset or goods and then sell them or lease them to you at a profit or at a rent. And in this case, what the bank does, it convert the assets or goods into debt. So they buy the asset for you or the good that you want, and then they allow you to pay in installment. So it becomes a debt. As opposed to, there is a direct mode of financing, also referred as equity-based financing, where the bank actually invests money into partnership. All right, it goes into partnership with you. So if you are looking for, let's say, financing a business, expanding a business or something new idea, they will actually put money and in a partnership with you, and then they will earn a profit. So basically, the bank takes a stake or equity of the business, and that's why it is called equity-based financing. So we said in Islamic finance, we have these different options. All right, we still mediate these 2 groups, but the solution that we have is much wider. So with indirect mode, we have murabaha, we have bay salam, we have istisna, we have ijara, and in direct mode, we have musharaka and mudaraba. So last time we started looking into this indirect mode financing, and the first one that we look at is murabaha. And we said murabaha is a cost plus sale where the seller discloses the purchase price and agreed the profit margin with immediate delivery. It has to be immediate delivery. And we said this is widely used by Islamic banks to finance assets such as vehicles, equipment, even real estate, if it is a small project, furniture, home appliances, whatever that people need, something that has a durable life. They call it durable goods because they have, long life. Murabaha is not used to finance consumable. You cannot ask bank to finance through murabaha your groceries, for example. All right, it has to be something durable. The profit is fixed and is not compounding, and everything is very transparent because they disclose the things to you. Even if there is late payment, there is no extra charge. And this is how it differentiates with the conventional loans. The conventional loans, if you delay payment, the interest is compounded and, it becomes not manageable at the end. So many banks, in order to discourage, I said, people being late in their payment, they put a nominal fee, and but this nominal fee, it doesn't go into the profit of the bank by law. If it goes, then it becomes riba. It is not Sharia compliant, and it goes into charity, and it is given in your name. So it is like you are donating something. So the banks are here involved in trading. They act like traders. All right. There's no difference between this kind of transaction. If you buy a car through the bank or if you buy the car through the showroom, there's not much difference that in terms of the transaction. The only thing is that banks don't keep stock of the thing that they're selling. They buy these goods on demand according to the customers. Still, they have to meet the condition of owning them because part of the being Sharia compliant, you cannot sell something before you own it. So the bank will actually own the asset or the good before they sell it to you. So we give example of murabaha for a car. So if the cost of a car is 20,000 and the bank, they have done their calculations, there's a lot of going on in terms of how do they calculate this, but we don't need to get into these details. So they will put a markup, let's say 20%. This is just an assumption, yeah? And therefore the total cost to you, to the buyer, will be 24,000. But everything will be disclosed. You will know. In fact, many banks, they will allow you to actually to go to the showroom, car showroom, and negotiate, the price, the minimum you can get. So you make sure that you get a good deal. And then the financing, let's say they agreed, the bank, to give you a finance for 60 months or 5 years. So the calculation will be very straightforward. The total cost to the buyer divided by how many months. So in this case, it's 400 riyals. Okay, here you have got a car as a, through trade transaction, and you have avoided riba. Okay, end of the day, in both cases, you get a car, whether you take a loan, car loan, or you do murabaha. You get your car and you're paying installment in both ways. But there's a difference because the other one, you're paying installment for the price of the car plus riba. And if you delay, you're compounding it. You are not Sharia compliant. As opposed, if you do it with murabaha, you have done a trade and it is a done deal. So there is no any repudiation in terms of the price. Okay. The other one we started to discuss last time is Bay Salam. And Bay Salam is a forward sale contract where full payment is made in advance for goods to be delivered at a future date. So here it appears like we're breaking the Sharia requirement not to sell something before you own it. But this Bay Salam is an exceptional. There is a maslaha for the society. That's why the Prophet has allowed it. And it has been allowed through hadith. So this is one of those very traditional Islamic contract. So primarily, Bay Salam is used in agricultural financing by allowing farmers to sell their crops before they are harvested and use part of their money, their income, for cultivation of the crops. This ensures stability of the food production. In today's term, we call it food security. So the quality, but this is the condition: the quality, the quantity, the delivery date of the goods must be specified in detail at the time of the contract. So Bay Salam has been permitted, as I said, because it stabilizes fluctuating agricultural prices, and it provides the farmers with the upfront fund, because otherwise the farmers will go into riba, because the farmer will need to be financed anyway. So if you're a farmer and you have a big farm, the cost of producing the crops, you will require financing, and you will go to the bank to take loans. So instead of taking loans, it can be financed through Bay Salam. All right. And this is the reason why the Prophet allowed it, because before they used to take loans based on riba. And the Prophet, made this exceptional rule. So this is a scenario. Let's say the bank buys 100 tons of wheat. So a farmer approached the bank, all right, and the bank buy 100 tons of wheat from the wheat farmer at a cost of, let's say, 200 per ton, delivered in 6 months. So the bank will pay the farmer all the money upfront, full amount. So 100 tons times 200 Riyal Oman, it will be 20,000. So the farmer will actually receive 20,000 fully and upfront to help the farmer with the cost of wheat cultivation. Now here, in terms of security, guarantee, and all of that, the requirement is there, because if you take 20,000, you have to somehow satisfy, the financier that you are trustworthy to be given this 20,000. So there's no question about that, and Sharia allows it. So if the market price of wheat rises by the time of delivery after 6 months, the bank actually will sell it at a higher price, and that's the profit that they're going to make. But also the bank has taken risk, because if the market price of the wheat has fallen, the bank will be forced to sell the wheat at a lower price, and therefore they will incur loss. And this is why it is Sharia compliant, because you have to take risk. It's not always that you have to make profit, like in fixed loans, fixed interest loans, you always make profit. And but the bank who is involved in buying products like this, they will have a unit that they will do all the market research. They will know the price. They will know prediction of the prices. And most of these products are sold in capital market. It's not like it's not like the level of risk is very low. So the bank might already have contracts or understanding with the buyers. When they get involved with this, they may have already, all right? So for example, if the bank has an agreement to sell the wheat, let's say at 250 per ton to a chain of bakeries or to a flour mill, all right, all these are, this is how it is done. that will give the bank a profit of 50 riyals per ton. And therefore, for 100 tons, they will make about 5,000. So instead of putting 20,000 into a riba, now 20,000 have been put in trade. So this is how Bay Salam works. Now, istisna financing, it looks like Bay Salam. In fact, it works in the same way. The only difference is istisna, it more focus on contracts for manufacturing and construction. And also the difference here, it allows flexible payment, because in Bay Salam, you have to pay the full amount upfront. Okay, but in Istisna, you have flexibility. You can pay upfront, but you can also pay installment. You can pay upon delivery, and this is the contract between the bank and the manufacturer, not with the end user, all right, the originator. So in Istisna, you have like two contracts. You have one contract between the originator and the bank, and you have another contract, it's another contract between the bank and the one who is going to manufacture or construct. All right. So as I said, the difference between Istisna and Bay Salam focus on agricultural products, as opposed Istisna focus on manufacturing and construction. And the other difference is in Bay Salam, there's no flexibility in terms of payment. Full payment has to be paid in upfront, otherwise it will not be Sharia compliant. All right, but in the case of Istisna, there is a flexibility, because when it comes to manufacturing or construction, usually you have a mode of payment, based on milestones. For example, construction, when you finish the foundation, when you finish block work, when you finish, sabia, when you put first floor or second floor. So there is a little bit of more flexibility in terms of payment. So Istisna financing is ideal for long-term projects, payment tied to construction or to production milestones. And Istisna contract must precisely define the asset type, size, material, quality, and delivery date, just like in Bay Salam. And Islamic banks commonly use Istisna to finance manufacturing and construction, such as real estate development, infrastructure projects, factories, large-scale equipment, machineries, all of these things that require to be made. All right. So let's take an example. This is in a scenario. Let's say the bank is going to finance construction of a solar power plant for a utility company at a project cost of, let's say, 1 million. Now you can see from this scenario, there is a company that will do construction, which is different than the company that is going to use this, which is a utility company. So actually here, the utility company is the one that approach the bank to finance this project. All right, but the one who is going to deliver is different, is a specialized solar power, manufacturer. So the bank will have, part of the deal is on completion, the plant is going to be sold to the utility company at a profit. All right, let's say the profit is 0.2 million. So the plant will be sold to the utility company at 1.2 million. So here the project cost is 1 million, all right? And this will be between the bank and the solar power company that will do the solar power. And then the bank targets a profit of 0.2 million, which is about 20% of the project cost. And then the utility company agrees to buy from the bank the solar power plant at a price of 1.2 million, but it will be spread over 5 years period, or let's say 60 months. So this is where the utility company benefit all right, because the bank is going to give them like a date. So they spread the payment. So the utility company benefit from the deferred payment plan and will make monthly payment 1.2 million divided by 60. That would be about 20,000 Omani riyals. And they'll be very happy to do that because they didn't have 1 million riyals to pay upfront to build the solar power plant by themselves. And here the bank has financed this big project, but through trade, not through loans. All right, this is trade, it's a done deal. All right, so it's very flexible. Now, just again, just to reflect between istisna and bay salam. Istisna is a sale of the manufacturer's or contractor's undertaking to produce specific asset, while bay salam, we said, is a forward sale contract where full payment made in advance for goods to be delivered at a future date. Bay salam and istisna are exception to the general rule against selling what one does not yet own. Istisna offer a more flexible payment plan compared to bay salam, which you have to pay full payment in advance. And in both cases, they have been approved because they offer benefit, maslaha. In the case of bay salam, it was approved through Prophet's hadith. And in the case of istisna, it was approved through ijtihad. In istisna, manufacturer or contractor actually possesses the skills and materials and the rights to manufacture or construct. And that's why effectively it's like owning the work in progress. And that's the reason they have been allowed to sell it under agreed terms. So that's the comparison. Okay, the last one is ijara finance. Now, ijara.
Chef Hafidh, I don't know what's the protocol for asking questions. Is it strictly at the end?
Yeah, at the end, we'll allow, inshallah, 10, 15 minutes, inshallah. I'm looking at the time.
I've posted a question, so
unless if you have a burning question.
No, I've posted it on the chat. It's about oil sales that we have between governments. Is it an example of Bay Salam or
not? I don't. I don't think the government is doing through Islamic finance. I doubt. All right, but I can look at it. Because government, has been doing this for a long time in conventional finance. But you say that when you sell, government is selling before owning extraction. They don't take payment. They have contracts, but they don't take payment. So I don't think it's a sale because they're not receiving the income. You get it?
Sometimes they sell before even extract it, but also they sell it at a later price. For example, today I sell it at 2-3 months beyond.
Okay, but do they receive the payment as well?
I'm not sure about that.
No, it's a promissory, so it's not a sale yet because Bay Salam and Istisna, you actually make the payment. All right. You make the payment so that when you say you don't sell something that you don't own, so to make the sale, you cut the deal and you receive the amount. Which I said last time, there are a lot of young people who are doing through Instagram. They take money from individual and then they go and buy the thing. That is something is not acceptable. But if you've taken order, but you're not taking the money, all right, so the sale is not yet done. Okay, but I will have another time. I will have somebody from the Islamic Bank to actually give a more specific question, inshallah. Okay, if you
Oh,
let me
okay.
go to
Yeah.
continue, yeah?
Yes. Thank
All
you.
right. Shukran. So ijara is an Islamic leasing agreement whereby the bank buys and leases out an asset. So the bank retains ownership and the lease payment constitute a return on the investment. So again, it could be somebody who wants to build a warehouse. You can use ijara finance even to finance, house, apartment, like a housing loan. An Islamic version of a housing loan, because you can approach the bank and the bank, if they agree to buy the asset, the property, and then they rent it to you, and then you're paying the rent. So the bank retains ownership and the lease payment becomes the return on the investment. Now, the responsibility for the maintaining the lease asset lies with the owner in Sharia compliant, because we do have lease in the conventional finance, but you are responsible to maintain it. But in Islamic finance, you have to maintain because you are the owner. The ownership is retained, with the bank, unless there is an exception if the tenant is has uh, affected the asset because of negligence. So if there is any damage on the asset or beyond, which is within his or her control, then there could be some discussion. At the end of the lease term, the tenant may have options to purchase the asset. This is what in conventional finance they call it lease to own. So in Islamic we have ijara muntahiya bitamlik, but this has to be lay out from the beginning, and you could have extending the lease, or you could return the asset to the owner. So we have all these options available in Islamic ijara finance. So let's take an example to just understand this scenario. And let's say Omar wants to acquire a 20-foot cargo truck for his logistic company, but does not have the funds for an outright purchase. So an Islamic bank agrees to buy the truck and to lease it to him. Let's say under ijara muntahiya bitamlik. It's not different than others, only minor, difference. Uh, so let's say that the truck price is 24,000, and let's say the total rate of return that the bank wants is 30% or 7,200. And this lease term, let's say, is 5 years, okay, which is 60 months. So the monthly lease is very straightforward. So you will take the truck price plus the rate of return that has been specified by the bank according to their calculations, and you divide by 60, and let's say it's going to come as 520 riyals. So Omar will be paying 520 Omani riyals monthly for 60 months. And because this is, this is ijara muntahiya bitamlik, at the end of the lease, there will be just a nominal fee, maybe to transfer mulkiya, because you have to have something to show there is a sell transaction. So it could be just a nominal fee. Even you could agree in the contract that you will pay 1 riyal, just 1 riyal, as a transaction to transfer, the mulkiya of the truck to Amr. So this is how ijara it works, and it can work with anything, because instead of a truck, we can put a warehouse, we can put aeroplane, We can put anything. We can put a building. The way it works, very simple, in a similar way. Banks, they could do as a business. So they could do this, let's say this truck, it is rented to Umar for 3 years. After 3 years, all right, Omar will return, will have the option to extend the lease or to return the lease, and then it can be leased to somebody else. But of course, the calculations here will be different. Okay, I have put the calculation where the bank wants to recover their cost fully and to get a profit, and to transfer, the ownership to Umar. So this is an example of ijara, right? Now, we move now to direct mode financing, right, or equity-based financing. And the first one that we look at is musharaka. So musharaka is a joint venture where all partners contribute capital. Okay, it's important. All partners, they must contribute capital in musharaka. In musharaka, profits are shared as agreed, but losses have to be shared according to the respective ratio of capital contribution. This is an important condition to make musharaka Sharia compliant. All right, they can agree on profit sharing because sometimes partners, one can have additional value into the partnership. All right, and the contribution, it doesn't have to all be money. It could be someone brings in property, mazra or something. Somebody will bring something different. But all of this has to be agreed on and to be evaluated as a capital contribution. Now, management of the partnership, it could be shared or it could be delegated to one of the partner, or even it could be given to third party. All right, there is a lot of flexibility in musharaka. Now, there are two types of musharaka. There is a permanent musharaka where the partners will remain with their country, with their shares throughout the existence of the musharaka, as opposed to diminishing musharaka, where one party will buy out the other. Okay. Now, in permanent musharaka, partners contribute capital and share profit and losses as long as the partnership exists. In diminishing musharaka, the partnership gradually decreases over time as one partner buys out shares of the other. Now, this one is very interesting one, diminishing musharaka. This is the best option to finance housing, all right, real estate. This is the best option. And it's very clear cut, and we'll run an example, inshallah. So let's look at a permanent musharaka, a scenario where a small business, it seeks funds to expand operation, and it partners with Islamic bank under musharaka finance. And to make things simple, let's say both agree to share the profit 50-50, okay? And the losses must be shared according to their capital contribution as a rule. And let's say in this situation, the business owner will contribute 35% of the capital and the bank contribute 65% of the capital. So let's say I don't know if this calculation is correct. Let's say the business owner put 70,000 and the bank put 130,000. So total investment is 200,000. All right. And in a scenario where there is a profit, let's say they made a profit of 10,000, all right, the profit they agreed to share equally. All right, 50-50.
Ijumaa
So,
every day 9:30.
huh?
Nataka kujionyesha account mate.
Okay, so the ratio is not correct. Okay, so irrespective, you can correct that. So in a profit scenario, they will split the profit 50-50. But in a loss scenario, they will share according to the ratio. Okay, so banks will bear more losses because their share is bigger. Okay, and the way you calculate this is straightforward. So in this case, is bank's share is 65%. So it's 0.65 multiplied by 10,000. It will give you 6,500. And the business owner, the loss will be 0.35 times 10,000, which is 3,500. Okay, so this is the permanent musharaka. Also, is very straightforward. It's very simple, and so instead of this small business, the business owner, to go to the bank and take a loan that is based on riba, okay, if he has something that is really convincing to the Islamic bank, so Islamic bank will chip in, all right, will take a stake into this, and the bank will benefit from profit, not from riba, and so is the business owner will get to finance his business through partnership. And here, bank, their focus will be on really looking at, the customer's ability to manage the business, all right, the skills of the person more than the credit worthiness. Because in a conventional bank, the bank to mitigate the risk, they are always looking at credit worthiness of the borrower. But in the case of musharaka and most of these this partnership, the bank is looking at someone who is reliable, who has got business skill and business acumen, who can actually run the business properly. Okay, so this is the difference. Now, in a diminishing musharaka, this is a little bit more involving. So let's say Mona wants to purchase an apartment, and the apartment, it is valued at 40,000, but she only has 10,000 to invest. So an Islamic bank may come in to finance the remaining 30,000 through a diminishing musharaka contract. So since the bank will own a portion of the property now, all right, Muna must pay rent for the portion of the bank, all right? And the Muna also agrees to buy the bank share gradually over 10 years period in order to become the sole owner, all right? So this is these are some of the assumptions that I've made for this scenario. So let's assume the rent is fixed at 5% of the bank share. Just say as a to be more objective. So also let's assume Mona is ready to redeem 3,000 of bank share annually. So 30,000, she will need 10 years to return 30,000. So every year she will return 3,000, okay, for 10 years. That will make about 7.5% of the total share that she's gaining, all right, annually. And this also, it will be 7.5% share of the bank reduced annually. So the rent paid by Muna will be also reducing because the share of the bank will be reducing consistently. So Muna will be paying less and less rent as years go by. And the total rent paid by Muna over the 10 years becomes the bank's income. So the income of the bank is only from the rent, because Muna will return only 30,000 in terms of, what the bank has financed this project. So I know this is it should not scare you. We can work it out slowly together. This is 10 years, outlook. If you look at the second column on the left, original Muna share is 25%. All right. And original bank share is 75%, because Muna put 10,000 and the bank put 30,000. And Muna will be buying back bank share gradually. Every year she will pay to the bank 3,000. So after 10 years, she will return, all the money that bank has put into this apartment. So if you look at the Muna's share is increasing gradually. So 3,000 will buy 7.5%. So her share end of the first year, instead of 25%, it has become to 32.5%. Second year, it has gone to 40%. Third year, it has gone to 47.5%. We continue like that until by end of 10th year, she got 100% ownership of her apartment. But if you look at the bank share is reducing also gradually. So initially it was 75%. By end of the first year, after they have received the 3,000 from Muna, it has gone to 67.5%. The following year, 60%. The following year, 52.5%. So it will keep reducing until the bank will have no ownership, right, by the end of 10th year. So you can see the Muna, as she put extra money, 3,000, her share in Real Oman is increasing until after 10 years, it becomes 40. And, bank share is reducing because they are receiving 3,000 from Muna. So by end of the first year, their value is only 27,000, then 24, then 21, then 18, all the way until it becomes zero. So the rent is calculated according to the bank share. So if we look at the first year, when the bank had 30,000 and the 5% of that is 1,500. But the second year, their value is only 27,000. So 5% of 27,000 is 1,200. So it keeps going down and down. So at the end, the banks has made 6,900 from this deal. No riba at all. The bank did not earn riba and Muna did not give riba. She has returned exactly the same amount that she borrowed from the bank, but during that time, 10 years, she only paid rent, all right, which is it's a normal transaction, Sharia compliant transaction. So this is how the diminishing musharaka. I can entertain question if somebody has not understood this. If it is clear, then we can move forward, yeah?
No, my question, Hafidh, is it what is being applied with the banks now, or this is what is we are just assuming, or we are presuming that the bank should be doing?
No, every bank, because when it comes to housing financing, there are many options. So this is one option. I have a friend who just recently went to a bank and they offered him this option of diminishing musharaka. I know Bank Nizwa, they have diminishing musharaka. So every bank, every bank and every situation, they may have different options, and it is, and for you also, you have to have a say on this, because we could have housing finance as murabaha, we could have housing finance ijara, and we could have housing finance in musharaka, diminishing musharaka. Right, and you need to weigh out the numbers, because each one may have slightly different parameters. Okay, is that clear?
Very clear, very clear.
Shukran. Now, I want to, when it comes to musharaka, there are other flexibility, but I'm not going to work on details and example, but I just want to, to make you aware. So actually, musharaka, there are two kind of musharaka. There is one is called shirka al-aqd, and another one is shirka al-mulk. Now, shirka al-aqd, there has to be a business entity. There has to be a business entity. So here you have something that has been registered, a business is running, all right? As opposed to shirka al-mulk, it is possible to have sharaka in owning an asset. It could be people they have inherited, it could be friends, they've decided to buy a property together, or brothers, they buy property. So there is no any organization involved. It's only reflecting on the mulkiya of that asset. And then you can have sharaka, and you can have sharing of profit and losses accordingly. In the shirka al-aqd, there is three possibility. One is shirka al-amwal, and this is what I demonstrated to you, between permanent musharaka and diminishing musharaka, because these are shirka al-amwal. There are money involved. There is a capital sharing. You put capital. Shirka amwal is something to do with capital. But you could also have a shirka al-a'mal. So this one is very common for law firms, for consultants companies, all right, for accounting, auditing firms, all right. They have shirka al-amal. So here there is no money involved as a capital. People, they get together and they put their their skills and time into the business, and they can agree to share according to the percentage of time and the labor they put in the business, right? And they can agree to share profit in any way they want, because someone may have more skills. In a law firm, for example, you may have two lawyers. They form a shirka al-amal. One lawyer can be senior, maybe dealing with high value cases. Another lawyer could be more junior. So they can agree how they share profit. One lawyer can put more time than the other. They can agree on that. But when it comes to losses, they will have to share losses according to the time, the labor and time they put to be Sharia compliant. The other one is shirka al-wujuh, and this is the no capital is involved directly, but you use reputation to take things that you're going to sell on credit because of your reputation. So two person, let's say mashahir is very common. They have the potential to use the shirk al-wujuh because they have social media presence. They have a lot of followers. So if they decide to sell to these followers, but they don't have money to actually get the products, they could get the products on credit from some suppliers based on their reputation. And then, you know, they can agree on how to share profit between them and how to share losses between them. All right. So this is another option. So the Musharaka partnership in Islamic finance is quite comprehensive. Okay. Now the other one, the last one is Mudaraba. Now, Mudaraba is a partnership such that one partner provides all the funds, and this partner is referred as Rabbul Mal, or the capital provider. And this partner has to remain a silent partner in a Mudaraba financing. This partner will take no part in day-to-day operations of the company. And you have the other partner contributes the expertise, the skills, the management skills, and is responsible for the day-to-day running of the business. So this would be the person who actually put the time. And in this construct, he or she is referred as mudarib, or entrepreneur. So in a mudaraba, we have Rabbul Mal and we have mudarib. Okay. Now, any profit are split according to pre-agreed ratio, but the financial losses are only borne by Rabbul Mal. So the mudarib will only lose the time, the effort, all right, but it is not going to be overloaded with the financial losses in a mudarib. And mudarib is, it goes back to the time of the Prophet himself, because the Prophet ﷺ, he had a mudaraba partnership with his wife, Sayyidah Khadija. Sayyidah Khadija was a Rabbat Mal. She was providing the finance, and the Prophet ﷺ, he was mudarib, he was an entrepreneur, you know, and they had the agreement between themselves how they share the profits. All right, so this is a very traditional Islamic contract. So just to look at a scenario, all right, and you know, today we have been able to do Mubarak. I think we'll stop after this to entertain any questions, and we'll continue. I think there is a need to continue next week, inshallah. So let's say this scenario, an Islamic bank, it uses Mudaraba to provide funding to a new technology startup. So some young people qualified, they have, you know, excited, they have studied this in universities, they have ideas, maybe to do some application, you know, AI, technology, social media, whatever. So, but they don't have the money, so they go to the bank. So the bank here will act Rabbul Mal, because the bank will provide the capital. Let's say in this scenario, the bank provide 50,000 riyals, and the technology startup becomes mudarib, okay, the entrepreneur, and they provide the expertise in the labor, and the profit sharing can be agreed. All right, so the bank will look into their own calculations. Let's say they agreed 60% for investors and 40% for the entrepreneur. So 60% will go to the bank and 40% will go to the entrepreneur. And losses, as a rule, the bank will absorb the losses. So unless, you know, here also I need to qualify, because if mudarab, you know, become negligent, all right, can be liable of the losses, all right. So but under normal circumstances, no. So assume a profit scenario, let's say of 10,000 in the first year. So bank's share will be 4,000 and entrepreneur share will be 6,000. Here, bank is not involved in the running of the business because that is the responsibility of Mudarib, and therefore bank, in order to choose the Mudarib, when you go with this kind of proposal, bank will really need to make sure that the people that they're giving this money, the idea is good, the market is there, and they have the capacity actually to deliver. So this is the scenario of Mudarab. Okay, I think we can, we can look into questions if there's any question, because we are almost there, and we'll inshallah we'll continue next week if there is an interest to continue. If you want it next week, or if you want a break and then we do another week later, it's up to you. Okay, Sister Ahlam, back to you.